Imagine this. A year where the stock market tanks, falls over a third, but then doesn't just recover, it hits record highs, all inside 12 months. How do you even begin to make sense of a year like that?
It's pretty wild to think about.
Totally. And that's exactly what we're diving into today, looking through the lens of the annual letter from Giverny Capital Inc.
Yeah, a really interesting firm.
They have such a distinctive way of looking at market volatility. And what I find really compelling is how they treat their clients. They call them partners. Because they manage the client portfolios exactly the same way they manage their own money. It gives you this incredibly open insider view.
That's exactly right. So our mission today really is to dissect their 2020 letter. And for them, it wasn't just, reporting numbers. It was a deep look at how their whole long-term philosophy held up during this just extraordinary year.
Okay.
We'll unpack what they learned, their core ideas about building wealth, and, how they actually apply it through thick and thin. We'll look at the real results.
Okay, so let's start right at the beginning for Giverny. It kicked off as a family portfolio way back in '93, inspired by the greats Buffett, Graham.
That's right. John Templeton, Philip Fisher, Peter Lynch, too. Giants.
So how did that sort of family thing evolve into this partner idea they have now?
Well, that idea being in the same boat, it's absolutely foundational. Giverny Capital Inc. officially launched in 1998, but that thinking was there from day one. And what's really fascinating about their annual letters, their main goal isn't just the numbers.
Right.
It's to really explain why they do what they do. Their core belief is, look, the market's irrational short-term, often, but long-term, it reflects a company's real intrinsic value.
Makes sense.
So that transparency, that dedication to teaching their partners, it's just central. It's how they'd want to be treated.
And that commitment, it seems like it even shows up in their aesthetics, right? Since 2004, the letters have artwork.
Yeah, from their corporate collection. The 2020 cover had this piece by Geneviève Cadieux, a photographic diptych, Alléluia avec main de femme. And the theme was social distancing. Incredibly fitting for 2020, wouldn't you say?
Absolutely.
Yeah.
Really sets the stage for, the craziness that followed in the markets that year.
It really does. I mean, 2020 was just a masterclass in paradox. You had the S&P 500 crash, 35%? The Russell 2000 down 40%?
All just weeks.
Exactly. The speed of it
Yeah.
only matched by the 87 crash. But what happened next was just, truly unprecedented.
Unprecedented, doesn't even begin to cover it. March 23rd, right? Huge U.S. government intervention starts. Giverny themselves said it made the 2008 bailout look like a, quote, dress rehearsal.
Yeah, huge scale.
And then the market just rips higher. An incredible rebound. U.S. markets hitting record highs by the end of the year. It was the first time ever a correction that big, over 33%, fully recovered in the same calendar year.
Wow.
So for investors, this whole whipsaw year really drove home a key point. Market chaos isn't just risk. Sometimes it's a massive opportunity if you just stay put. How did that play out for people who tried to time it?
Oh, it's a powerful lesson. Giverny pointed out, if you missed just the best 5 trading days in March and April,
Just 5.
just 5 days, you missed a huge chunk, maybe most, of that incredible recovery. It just highlights how dangerous market timing is. And, the pandemic also massively accelerated stuff already happening. Online shopping, working from home.
Oh, yeah. Things that are just normal life now.
Exactly. Integral.
Speaking of unprecedented, their letter mentions a strange thing that happened April 20th, 2020. Can you walk us through that West Texas Intermediate crude oil thing? It sounds like a perfect example of what Buffett says about strange things happening.
It absolutely is. Get this. The price of a futures contract for WTI crude oil. That's basically a deal to buy or sell oil later at a set price.
Yeah.
It didn't just fall. It went from $18 a barrel to negative $37.
Negative. How does that even work?
Think about it. Sellers were literally paying buyers to take the contracts because physical storage for the actual oil was full. Nobody wanted to take delivery.
That's insane.
Truly insane. And it just starkly showed the huge dangers of using borrowing money to invest. This whole weird event just hammered home Giverny's core idea. Act like an owner of a business, not some short-term speculator caught up in the daily noise.
Right. Ignore the noise. Which kind of leads to what Giverny called the flavor of the day in 2020. What sort of speculative stuff were they seeing then? Did it remind them of anything?
Oh, it was eerily familiar. Very late 99, early 2000 dot-com bubble vibes.
Okay.
You saw this huge surge in speculation, especially in software, cloud computing, e-commerce. Now, look, these sectors definitely had real growth, absolutely. But the problem was what Giverny called infinite extrapolation.
Right.
Investors basically assuming that crazy growth would just go on forever. So you had companies trading at 60, 80, even 100 times profits, or, if they had no profits yet, just insane price to sales ratios, which can be a huge red flag for speculation.
That sounds exactly like that fable Giverny told in their 1999 letter about the farmer bragging his pig was worth $1 million.
Right.
It's because he traded two $500,000 chickens for it. It's perfect. Just shows how intrinsic value gets totally tossed out the window. Did they see any, standout examples of that kind of thing in 2020?
Oh, absolutely. It really rhymed with the past, as they say. If you want an example of value being ignored, just look at Tesla in 2020. Its market cap hit something like $800 billion.
Which was more than
All other car companies combined. Even though it sold 120 times fewer cars that year, it just screams speculation. Like Mark Twain said, right? History doesn't repeat itself, but it often rhymes.
Wow. Okay, so with all that chaos and speculation flying around,
Yeah.
how did Giverny's patient, long-term approach actually perform for their partners in 2020? And what about the longer view?
Okay, let's look at the numbers. So in 2020 itself, their main Roshan global portfolio returned 12.9%, which actually was a bit behind its benchmark by 2.2%.
Okay, a slight underperformance short term.
Exactly. But contrast that with the long haul. Since they started it July 1st, 1993, that same portfolio has compounded at, get this, 15.3% a year.
15% compounded.
Yeah. Outperforming its benchmark by 5.9% annually. That adds up massively over time. And other portfolios showed similar long-term strength. The U.S. one added 4.5% year since 93. And the Canada portfolio actually crushed it in 2020, 12.1% versus the index's 5.6%, mostly thanks to one Canadian stock that was up 31%.
So that shows how a concentrated portfolio managed well.
Exactly. It can really outperform an index over time.
That long-term record is impressive. But honestly, what I find even more compelling is how open they are about learning. They have this thing called a podium of errors. Why is being so public about mistakes important to them? And what kind of mistakes do they see as the worst?
It's a great point, and it goes right back to that partner idea. They feel it's not enough to just say, oops, we were wrong. They want to understand how they were wrong, echoing Claude Bernard. It helps their partners understand the process. And they found, interestingly, is that errors of omission.
Meaning not buying something.
Yeah, right. Not buying a stock they should have. Those are often way more costly than errors of commission buying something that doesn't work out. Because you don't see those missed gains on your statement, right?
Yeah.
But they can be huge.
Can you give us some examples from that podium to make it real?
Sure. So for the bronze medal era, they talked about floor and decor. Great business. They identified it. Stock drops from $60 to $25 in the March 2020 crash. They decide, okay, we'll wait for our price, $30.
Okay, a target price.
Right. But the stock jumps over 10% the very day they plan to buy. Never look back, hit $102. The lesson, don't get too cute trying to time a great business.
Ouch. Okay, silver.
Silver medal went to Taiwan Semiconductor, TSM, amazing company, great outlook. But they thought $50 is a record high end of 2019. Let's wait for a better price.
Uh-oh.
Yeah. In 2020, TSM's earnings per share jumped over 50%. Stock more than doubled to $127. Another miss because they were waiting for that perfect, maybe non-existent entry point.
These are painful. What got the gold medal?
The gold medal was Poolcorp. They studied it way back in 2006, dominant company. But they worried it was too cyclical, tied to the economy.
Okay.
So they missed buying it for $11 during the 2009 panic, even though it was only trading at 6 times its 2006 profit, and it stayed profitable through the whole downturn.
And
by 2020, its earnings per share were $8.42. Stock was at $325. That's a potential gain of almost 3,000% since 2009 they missed. The error was letting fear of cyclicality override seeing a quality business on sale.
wow, those are powerful stories. It really makes you think of Philip Carrett's old rule from the 1930s. Be quick to take losses, reluctant to take profits. Let your winners run, right?
Yeah, exactly.
And Giverny also talks about owners' earnings. How do they use that to figure out what their companies are really worth, especially in a crazy year like 2020?
Yeah, it's crucial for them. Owners' earnings, that's a Buffett concept. Giverny uses it to gauge the true intrinsic value. Basically, looking at earnings per share growth plus the dividend yield. And they believe, it's better to be roughly right than precisely wrong when estimating this.
So what did it show in 2020?
Well, here's the interesting part. In 2020, based on this owner's earnings metric, the underlying intrinsic value of the companies they owned actually declined by about 2%.
Declined. But the portfolio was up.
Right. The portfolio return was roughly 15%. It just perfectly shows how much market prices can disconnect from the underlying economic reality in the short term. And that's where the opportunities lie for patient investors.
Okay, now for something really different. Inspired by physics equations, Maxwell's equations, Giverny proposed 4 equations for rational investing.
Yeah.
These aren't actual math problems we need to solve, are they? How should we think about them?
No, definitely not calculus homework. Think of them more like distilled principles, core beliefs framed like fundamental laws of investing.
Okay, walk us through them briefly.
All right, first, the equation of convergence. Basically means, long-term, a stock's market price will eventually reflect its true intrinsic business value. So patience wins. The market might be crazy today, but reality catches up.
Got it. Number 2.
Second, the equation of wealth increase. This is just a reminder that building wealth isn't really about market timing. It's about the cumulative effect of patient investing over years. Your wealth grows based on your sort of aggregate patience.
Makes sense. Third,
the risk-decrement measurement equation. Sounds complicated, but the idea is simple. Risk goes up with weak profit margins, goes down with less debt, and goes down a lot with strong competitive advantages. They even square the competitive advantage part to stress its importance. Basically, strong, profitable, low-debt businesses with moats are safer.
right, focus on quality.
It is.
And the last one.
Finally, the equation for normalization of parameters influencing returns. This is their fancy way of saying stock returns tend to follow a curve. You do better if you're rational, that's moot, and worse if you just follow the herd instinct. That's sigma, simple translation. Rational investors beat the herd over time.
Those are really neat ways to frame their core ideas. And it kind of brings us to their big picture conclusion. After doing this for nearly 30 years, what does Giverny think is the single biggest mistake investors make?
Yeah, after all that time, they are absolutely convinced. The biggest mistake is trying to predict the market. Full stop. Doesn't matter if it's waiting for a better time to buy, or selling because you think things will go lower, or just waiting for everything to seem clearer. That urge to forecast, it's the fundamental error.
But investing in stocks is still the way to go.
Absolutely. They stress it's fundamentally a winning long-term game. Just owning solid companies has historically generated, 8-9% annual returns.
So during a crisis like 2020, what's the key takeaway?
In those moments of pure chaos, they say it's vital to remember Peter Lynch's big picture idea from his book, Beating the Street. Focus on the bigger forces. Civilization keeps progressing, capitalism is resilient, humans are really good at solving problems eventually. Those big trends tend to win out over short-term panics.
So it really boils down to a kind of golden rule then. Don't forecast. Stay invested in good companies. Focus only on their real value.
Exactly. If you can just remove that urge to predict, you eliminate a huge drag on your own returns. You consciously decide to let time do the heavy lifting.
What a deep dive. Really shows how a firm like Giverny can stay anchored to its principles, even with, negative oil prices.
Yeah.
Or a market recovery that defied all history.
Yeah, their whole experience just demonstrates that, okay, the market's chaotic short-term, sometimes completely ludicrous, but that volatility, it's not something investors should fear.
Right.
For the intelligent investor, it actually creates the opportunities. You get chances to buy superb businesses at good prices if you have the patience to see past the noise and stick to valuing the business itself.
So maybe a final thought for everyone listening. As you look at your own financial journey, maybe consider this. In a world that just constantly hits us with breaking news, immediate opinions, short-term swings, how can you build up that kind of unwavering patience? The kind you need to really let your long-term investments do their work and thrive